Today, you guys are going to learn the most important thing when it comes to trading, and this is the whole entire reason why people fail at trading and why they are unprofitable. This is why people continue to blow their accounts, and this is why they do not have a continual long-term edge against the market. So now let's go right into it. As you guys can see, proper risk management. But this is not going to be some basic risk management type of thing. This is going to be the mentality when it comes to that risk management, because yes, I could talk about risk management this entire video, but the most important thing is how you actually approach that risk management. So let's get right into it. Now, the first thing that you want to establish is having an edge. The edge is the most important thing. Think of it like a casino. For example, if the casino never had an edge and it was always a 50-50 shot, they would be out of business. It wouldn't make sense for the casino to run on a 50-50 probability. They need at least some sort of edge. Even if it's 49 to 51% probability and they have a 51% chance of winning, that's still a 2% edge over everyone else, which will then lead them profitability if they control their risk the proper way. So even if you have a risk, so for example 49% to a 51%, and that's a 2% edge, unless they are able to control the risk, it doesn't matter, because someone can come in there and let's say they're consistently making $500 and the next game they win $500. Someone comes in and they lose like $490 or something like that. But then they don't control the risk and they don't have a max stop loss, and someone comes in there with $50,000 and they bet it all on black and they hit black. The casino is now down $50,000 on one single bet, which is why it's super important to make sure that your position size is always around the same and your max loss is always that same. Because if the casino didn't have a max loss like that, when they make 500, they make 500, they lose 400. Next thing you know, a big baller comes in and they lose $50,000. Just like that. Even though their win rate is 50% right now, you could still be very, very unprofitable. Which leads me to my next point, is position sizing. All right, so let's pretend like we're about to enter a trade, right? So let's say, for example, this thing is about to break up to the upside and this stock is $20, right? Our stop loss in this, we have to know our stop loss. You can't fully guarantee that this thing is going to go in your direction. You never can, and you always have to assess your risk. Every single time you're getting into a trade, you have to know your risk. I know that if I'm wrong in this trade, this is how much I'm going to lose. I'm going to lose $2 because my stop loss is going to be $18. So I'm going to lose $2 for every single share that I buy. And my upside, so let's say, for example, my upside, at least a 1-to-1 risk to reward here. Let's say this goes up to 22. That's where I'm going to sell. That's my target. So my target is 22. 1-to-1 risk to reward. As long as I have a 51% win rate, I'll be profitable in the long run as long as I manage my risk. So let's say, for example, I have a $10,000 account and I have a 2% max stop loss on my entire account, which means I can't lose more than $200 on this entire account. This is exact strategy will set you up for long-term success in the market. So let's say, for example, negative 2%, that is $200. That is my max loss on the day. I can't lose more than $200 on the day. Now, how do we get our position size? We go by our stop losses, right? So for example, if my stop loss is negative 10%, which in this case it is, 10% of $20 is $2, and you know your strategy is very consistent. So let's say at most you're going to lose twice in a single day. If that, we got a plan for, you have to be very conservative when you make this. So that's a negative 10% stop loss. So if you're going to lose 10% on this trade, our position size will be around $1,000, right? And the reason being is because if you lose 10% of 1,000, that is negative 100, which is half of that negative 2% on the day for your entire account. So you can use around 10% position size and you'll be fine. But after that second trade, so let's say you lose again, and that's when you're just going to stop trading, right? So now what happens if this stop loss, let's say, for example, this was stop loss of 19, which is only a 5% stop loss. What is going to be our position size now? Well, again, our position size is based off of our stop loss and our max loss for the day. So in this case, we have a 5% stop loss. Let's say you want to use half of your max loss for the day because you know that you have a very consistent strategy, and after 2 losses, you want to be done on the day. At most, your position size is going to be $2,000 because if you lose 5% of that, that's $100 loss. So then if you do that times 2, that gets you that max loss for the day. See how risk management and position size is very important? This will help you eliminate those max losses. This thing could literally be a 50% stop loss. Let's say you always take a 50% stop loss. As long as you have the proper position size, your max loss will still be good on the day. You know, that negative 2%, you can't lose more than that per day, and that's at most. So if you know you're going to lose 50%, and let's just say one single loss and you're done in the day, at most your position size is going to be $400. You could only put $400 in this trade, because if you're wrong on it, and you can never guarantee that you're going to be right on the trade, if you're wrong on this trade, you're going to lose 50% of that position size, which will get you to that max loss. You can't risk the same position size if that risk percentage is not always constant. If it's a negative 20% stop loss, or a negative 50% stop loss, or a negative 10%, that position size has to change so it stays within that max loss. Now, if your position size is always the same and your risk per trade is always the same, because mine is, for the most part, it's always around that negative 5 to negative 8% if I'm wrong in the trade. So I position size accordingly to my highest stop loss. On average, statistically, my percentage stop loss has never exceeded negative 8% usually. So I position size according to that. I'm not going to hit my max stop loss on a day unless I hit 4 different trades that take a loss. And that's how I plan. If I take 4 different trades for the day and they're all losses, which again, after the second loss, I better be done on the day, even if it doesn't hit my max loss, just because I know something's going on today. I'm not on my game today. I'm just going to get fully out. I'm done. But let's just say it just so happens that I hit 4 back-to-back losses. That's when it hits my max stop loss, because I know that my risk on each single trade is constant, so I position size accordingly so I don't even go near that negative 2% on my account per day. Now, you have to understand that you want to take the most high probability, high profitability setups. I only take the best setups. I'm not going to take a setup where if I get in, I pay 20 per share, and my stop loss is going to be at 15, and then my profit target, as much room as I think it has, is only to 21. That wouldn't make sense. I'm risking $5 to make $1. It doesn't really make sense there. What I like to do is at least a 2-to-1 risk to reward, or at least a 1-to-1 risk to reward, because the way that I trade, my win rate is very high, because that's the way that I trade. It's just how my strategy is, that a 1-to-1 risk to reward on an 80% win rate, you'll still be profitable in the long run. You got to make sure that it makes sense statistically and mathematically, or else you're just not going to be successful in the market whatsoever. If you're taking a 50% stop loss every single time and you're only making 10% and your win rate's like a 60% win rate, you're statistically not going to be profitable. Mathematically, that makes absolutely 0 sense. So I'll get in, for example, at $20, my risk, negative 19, my reward, 21. If I do that with an 80% win rate with the right risk management, you'll be profitable in the long run. It's all about math. That's what trading is so important, because you have to write everything down. You make sure that your risk is there, and then you're able to trade. I'm not going to get in the trade without knowing my risk. I'm not going to go in the trade without knowing my exit strategy. Everything has to align. It's literally just one single plan, one single blueprint. That's literally trading. Before I get into the position, I know my position size. I know that it meets that negative 2% stop loss on my entire account for the day. I know that checks off. I know my position size checks off. I know my risk going into the trade, usually around that 5 to 8%, but it depends on price action. And I also know that my reward is bigger than my stop loss, or it meets that stop loss, because it's the usual setups that I take. I know that the usual setups that I take usually will yield around 8 to 10 to 15 to 20% on average. So knowing this, and it's a high probability setup, it's the exact setup that I always trade, and I see that it keeps setting up and this is a high probability trade, I will 100% take it. Now, for example, if it's not setting up that great and I see that there's just a huge wall right here and there's a level right here that I want to play super close to that, and my stop loss is going to be at 15 right here, and I'm going to get in at 17, but my reward is only 17.5, it wouldn't really make sense for me to potentially gain 50 cents on this not high probability setup where I have a bigger chance of losing on this trade. Because remember, we needed an edge. You don't have your edge in here. And you're also, if you're wrong the trade, you're going to lose $2 on this. That risk reward standpoint right here, it just doesn't make sense. You have to make sure that it's high probability setups that have a nice risk reward, at least the one that won the risk reward, and your checklist makes sense. You have to make sure in your head or whatever you're doing, you have a checklist. Does it meet my position size? Check. Is it within the negative 2% max loss for the day? Check. And that just goes back to the position size. Your position size has to equate to that negative 2% on your account or less. Remember, that's just a max. There's no minimum, for your position size. You can go way less, and that's what I do. Why would I position every single trade like I'm going to lose negative 2% on my entire account? It wouldn't make sense. And then the last thing is risk to reward. Is your risk to reward there? If all of those make sense and it's a high probability setup, then you're good to go. But I see a lot of people making the opposite mistake. Number one, their position size is going to be like $10,000 on this trade and then $3,000 on this trade. Stop loss in this one's going to be like negative 20%, and then they got scared that they lost 20% on that, which is negative 2,000. And then let's say they hit a trade for plus 30%, which again, if you were using the proper risk management and the proper position size, you should be profitable with a 50% win rate with these two percentages. But then if you look at the position size, it wouldn't make sense because now you only made 900, but you lost 2,000. But this 30% minus 20%, you should be up 10% on that position size, but instead you use a $10,000 position size and a $3,000 position size, which makes no sense. So if you actually understood the risk management here and it was the same risk on both and you used 5,000 position size, you would come out profitable. The one, you'd be up 1,500, and the other, you'd just lose 1,000. So you would be up about $500 on the day with a 50% win rate with that position size. See how the math is now mathing on this? It makes sense. So you need to start logging it. You need to start thinking, and you don't have to do this every time where you're just writing it down, but at least do it so you know, okay, if my account, for example, my account is $3,000, right? My max stop loss in the day is going to be that negative 2%, which is $60. So you're going to lose at most $60 when you're trading and on the day. So if you have 3,000, your position size, if you know you lose 10% every single trade, your position size should be no more than $300. Because if you lose 10%, you're going to lose $30. Then you could take 2 trades, which gives you that max loss for the day. And this is how you position size. But instead, a lot of y'all want to do $1,000 position size with a negative 10% stop loss, which gets you negative 100 for the day. Now your account's down like 3%, 3.5%. It just doesn't make sense why some of y'all are trading the way that y'all are trading. You could have a profitable strategy, but if you do not exercise the proper risk management, not going to be successful in the long run. So hopefully this video helped you guys, and I'll see you guys in the next one.